I did my presentation on the 2008 financial crisis. A recession is when there is negative growth in the economy or GDP for 2 or more consecutive quarters. However, this recession was called the Great Recession, which basically means that we haven't seen this amount of downturn in the economy since the 1930s depression. Therefore, the effects of this will be companies going out of business, with unemployment increasing and spending in the economy falling. This creates a negative multiplier effect and a downward spiral. The first trigger was easy lending in the housing markets, as banks gave mortgages to people that could not possibly pay back the money. People were also encouraged to borrow due to the low interest rates. Banks knew that people could not possibly get their money back from their customers, therefore they passed these loans onto other institutions in order to make a profit. They were allowed to do this due to the decreased regulation of the banks by government to encourage the economy to grow and create wealth. The outcome was a housing boom, creating a bubble where there was an increasing cycle of house prices in the stock market. The first place where these toxic loans arrived were Wall Street, where they were packaged up into extremely complex algorithms that nobody could understand, and these were sold around the world. Due to the AAA credit ratings, banks didn't care whether they understood them or not, as it was meant to be a risk-free investment. From this timeline, you can see that there are a lot of events happening in a very short amount of time. If there was not as quick and effective response as there was in 2008, it is predicted that there could have been a Great Depression or worse, a collapse of the system. Hank Paulson saw the series of this economic crisis, which allowed for a quick and effective response, which saved the economic downturn from being much worse. For example, he said, "If we do not act now, there will be a depression deeper than the Great Depression. This is the financial equivalent of war, and we're going to need wartime priors." Also, Lehman Brothers were allowed to fail. This sent a message to other banks that they were not safe, which led to banks allowing the government to nationalise them as they knew they were not safe, which was different to the perception that they had before the crisis. Paul Kanjowski highlights the seriousness and how quickly things could have gone wrong. If it wasn't for the government guaranteeing that people's money were safe, too much money would have been taken out of the system, so much so that banks would have not been able to trade, invest, or lend money to each other, which would have collapsed the entire system, as he claims, within 24 hours. Another reason why this crisis was so severe is that the investments were highly leveraged, as seen in this picture. This shows that the higher the leverage ratio, the higher the return and risk. For example, if you had a leveraged investment at 1 to 1, you would have a 100% increase to double your return. However, if it was 1 to 2, it would require a 50% increase, and 1 to 10, a 10% increase, and so on. However, banks such as Lehman Brothers were leveraging at 1 to 36, meaning that you needed about 2 to 3% decrease in the investment for them to lose 100% of their money. Iceland privatised its banks, which opened in England, to encourage people to save money in Icelandic banks. Because British people lost money, Gordon Brown retaliated by putting the banks on a terrorist watch list, along with Al-Qaeda and the Taliban. General Motors, one of the largest corporations in the world, went bankrupt as it was nationalised by the US government, which saved people's jobs. It is estimated that 200,000 jobs were saved by bailing out General Motors. On one hand, this kept unemployment lower. However, this created inefficiencies in the market, as there was too many cars, and added to the taxpayers' bill. Unemployment here has more than doubled from the 2007 low to the 2007 high of under 5% to 10%. Since there has been a gradual decrease in unemployment to another low of 2015, and it's still decreasing, this is one indicator that the economy has been improving since the 2008 crisis. Unemployment increases the dependence on the welfare states, which will yet again add to debt and taxes. However, other factors should be considered when making assumptions about unemployment, such as the labour participation rate, whether it's seasonally adjusted, and which measure it is. For example, the U3 or the U6 measure in the US, one side than the other. Home foreclosures here have more than doubled between 2007 and 2009 from roughly 1.3 million to 2.8 million. This has also decreased the wealth of the average person and forced them to be homeless, which may lead to an increase in crime such as burglaries in order for them to make a living. In the US, Fannie Mae and Freddie Mac backed about half of all mortgages. Therefore, when the 2008 recession hit, they both went bankrupt, leaving the US government to bail them out. According to the Congressional Budget Office, the true cost of the bailout was $317 billion, not $130 billion. This is one of the largest bailouts in US history. The picture shows the bailout was nearly as big as the banks, which were $250 billion. In the long run, this adds to the national debt, which has to be paid back. This slide shows that the US national debt is over $18.4 trillion and is exponentially increasing. In the last 8 years, the debt has nearly more than doubled since George W. Bush. In the long run, this has bad consequences for the US taxpayer as the debt has to be repaid back. Eventually, countries will stop lending to the US, which will cause the government to take money from its citizens through pensions and bank accounts. In fact, we've already seen this happen with the debt ceiling, which was reached in October, where the government had to borrow money from its citizens to fund the government temporarily. We've also seen countries move away from the dollar, such as China, which unpegged the yuan, and started to sell US government bonds in fear that they may not repay the debt. Too much debt is bad, as governments will have to make major cutbacks, as we saw in Greece. You can see this from this picture of the Dow Jones Industrial Average that the US stock market went down to half of its value from $14,000 to about $7,000. This means that if you invested at the peak, you would have lost half of your investment. This could have a knock-on effects such as the wealth of the people that was lost, which means they won't spend as much in the economy. For example, retired people may have their pensions wiped out, which means they'll have to go back out to work for a living. Many businesses may not be able to pay their bills and unemployment will increase, and this will create a continuing negative spiral. Economists can also look at past trends to predict future economic crisis. For example, in this picture, you can see that every 7 years there seems to be a stock market crash or a major event happening around the world. This picture shows the price to earnings ratio. This is to predict bubbles in the stock market. For example, if it was a 1-to-1 ratio, it would take 1 year to match the value of the investment companies to the stock exchange. So if it was 10-to-1, it would take 10 years to get for companies to produce enough revenue to equal the amount of money in the stock market. In 2008, the price to earnings ratio was 28-to-1, meaning there was 28 years for companies to equal the amount of money in the stock market. The average is 16.6 years, and anything over 22 can be considered a bubble. A lot of statistics published by the government are altered to make them look better for political reasons. For example, this graph from Shutterstats.com shows that the inflation rate has been greatly varying as time goes by from 1980 to the present day. For example, the difference between the 1980 base measure and what it is today is 8% on the Consumer Price Index. It's very hard to predict economic crashes, especially on a specific date. Using Keynesian economics, we can relieve the effects of economic crashes through stimulus packages. However, Hayek would argue that relying on the government will encourage banks to take risky action and the market will correct itself anyway. One way economic disasters can be avoided is if the government controlled the market to stop it from fluctuating so much. Another way is going back to the Bretton Woods system, where currencies will be backed up by the dollar, which will be backed up by gold, meaning there will be less inflation in the market, making the market much more stable. The end.